Hello, XRP Army, and welcome back to the Crypto Republic, your go-to channel for the latest technology updates in digital assets. Before we get started with today's business, make sure to smash that like button, ring that bell, and subscribe to the Crypto Republic, bringing you updates every day at noon and 7 p.m. Eastern Standard Time. Just a reminder, this video is for educational purposes only. This is not financial advice. Always do your own research before making any investment decisions. What if the biggest shift in financial history isn't happening on Wall Street, but underneath it? What if the infrastructure that clears and settles virtually every stock, bond, and ETF transaction in America is quietly preparing for a blockchain-powered future? And what if the winners of that transition aren't Bitcoin and aren't Ethereum? Over the past several months, discussions surrounding the Depository Trust and Clearing Corporation, the DTCC, have intensified. Patents, tokenization, blockchain partnerships, institutional working groups, and persistent speculation surrounding the potential roles of XRP and Stellar's XLM. If part of this vision becomes reality, the implications could extend far beyond crypto markets, because this isn't just about digital assets. It's about rebuilding the plumbing of global finance. And when infrastructure changes, everything built on top of it does too. To understand why this story matters, we first need to understand what the DTCC actually is. Most investors have never interacted directly with it, yet almost every investor depends on it. The DTCC sits at the center of U.S. capital markets. It provides clearing, settlement, custody, and post-trade infrastructure. In simple terms, when stocks change hands, when bonds settle, when ETFs are transferred, there is an enormous amount of invisible work happening behind the scenes. That work helps ensure buyers receive assets, sellers receive payment, and the financial system remains stable. This is very important. The organization overseeing infrastructure connected to tens of trillions of dollars in assets and processes staggering amounts of transaction volume every year. This is why every conversation involving DTCC modernization attracts so much attention. When a system this important experiments with new technology, markets pay attention. Not because of hype, because of scale. And scale changes everything. Now, this is what most people miss. The blockchain discussion isn't really about cryptocurrencies. It's about efficiency, settlement speed, collateral movement, liquidity management, interoperability, and reducing friction between financial institutions. For decades, financial markets have operated through layers of intermediaries. Many of those layers existed for good reasons, but they also create delays, costs, reconciliation problems, and operational complexity. Tokenization attempts to solve some of these challenges. Instead of representing ownership through traditional database alone, assets can be represented digitally on blockchain-based systems. Stocks, bonds, treasuries, funds, real estate, almost anything with ownership rights could theoretically become tokenized. The promise is simple: faster settlement, greater transparency, improved programmability, and potentially more efficient use of capital. But here's where it gets interesting. The challenge isn't creating digital assets. The challenge is connecting everything together. History offers an important lesson. In 1869, the completion of the first transcontinental railroad fundamentally changed the American economy. Before it existed, regional markets were fragmented. Goods moved slowly. Prices varied dramatically between regions. Commerce was limited by transportation infrastructure. Then the network connected. Suddenly, capital, products, and information could move more efficiently across vast distances. Economic activity accelerated. The railroad wasn't valuable because it created products. It was valuable because it connected systems. Today, many analysts believe tokenization faces a similar challenge. Creating digital assets is relatively easy. Connecting isolated digital ecosystems is much harder. And that's where interoperability becomes central to the conversation. Over the past few years, DTCC has explored multiple blockchain-related initiatives. Industry participants have discussed how distributed ledger technology could improve market infrastructure. Working groups have examined settlement efficiency. Financial institutions have tested tokenized assets. And discussions about bridging traditional finance and decentralized finance have intensified. Supporters believe the future may not be traditional finance versus blockchain. Instead, it could become traditional finance integrated with blockchain, a hybrid system, one where existing institutions remain important, but operate with upgraded technology. That's a very different narrative from the early crypto movement. The original vision often emphasized replacing legacy systems. Institutional adoption focused on enhancing them. Short-term noise, long-term structure. That's the distinction investors should pay attention to. One development frequently cited by XRP and XLM supporters involves patent filings and technical documentation discussing multi-ledger environments. These discussions have fueled speculation that certain blockchain networks could play specialized roles within future financial infrastructure. According to proponents of this thesis, Stellar could become useful for asset issuance and token management. Meanwhile, XRP could potentially function as a liquidity bridge between disconnected systems. Whether the specific vision materializes remains uncertain, but the concept itself is important because modern financial markets suffer from fragmentation. Different countries, different currencies, different ledgers, different custodians, different settlement systems. Moving value across these networks often requires substantial capital and operational overhead. Write that down. That's really important and massive. Let it sink in. The search for a neutral bridge asset is one reason XRP, the anointed one, continues attracting institutional attention. Not because of retail speculation, because liquidity problems are expensive. But the real shift came when tokenization stopped being a crypto conversation and became an institutional conversation. Today, some of the world's largest financial organizations are exploring tokenized assets. Asset managers, banks, exchanges, custodians, clearing institutions, technological providers. Everyone sees the same trend. Financial assets are becoming increasingly digital. And once assets become digital, expectations change. Investors begin asking difficult questions. Why should settlement take days? Why should collateral remain trapped? Why should liquidity remain fragmented? Why should markets operate on schedules designed decades ago? This is massive. Write this down. This is it. This is really important. These questions are driving experimentation across the industry, not because blockchain's fashionable, because efficiency has economic value. History provides another powerful example. In 1971, the United States formally ended the convertibility of the dollar into gold. The event fundamentally altered the global monetary system. What made the shift so significant wasn't merely the policy change itself. It was the transformation of underlying financial architecture. Entire industries adapted. Capital flows changed. Global finance evolved. The lesson is simple. When foundational infrastructure changes, markets often experience effects that extend far beyond the original decision. That's why observers are watching tokenization so closely today. Because if market infrastructure evolves, the consequences could ripple throughout the entire financial system. Let's talk about the growing interest in extended trading and settlement windows. Traditional markets were built around business hours. Digital networks operate continuously. The mismatch has become increasingly obvious, ladies and gentlemen. Global investors want faster access. Institutions want greater efficiency. Technology allows continuous processing. As a result, discussions around longer operating schedules have intensified. Many market participants view expanded operating hours as a logical step towards more digital markets. The significance goes beyond convenience. Faster processing reduces counterparty risk, improves liquidity, and potentially frees up capital that would otherwise remain locked in settlement cycles. Again, the story isn't crypto, it's infrastructure. Here is where it gets really interesting. Tokenization doesn't simply digitize assets. It changes what assets can do. Imagine stocks capable of serving as collateral instantly. Treasuries moving across networks in real time. Funds settling without multiple layers of reconciliation. Assets becoming programmable. These possibilities explain why major institutions continue investing resources into tokenization research. Some analysts estimate that tokenized assets could eventually represent trillions of dollars in value. Whether those projections prove accurate remains unknown, but the direction of travel is becoming increasingly clear. The financial industry is exploring digital representation of traditional assets at unprecedented scale. Prices reacting, systems evolving, and those are not always the same thing. One analogy helps explain the current landscape, ladies and gentlemen. Think of the traditional financial system as a collection of medieval cities surrounded by walls. Each city functions effectively on its own, but trade between cities is slow, costly, and complex. Now imagine building a network of modern highways connecting them. The cities don't disappear. They become more valuable because they're connected. That is how many institutional participants view blockchain infrastructure, not as a replacement for existing systems, but as connected tissue between them. The focus shifts from disruption to integration, from competition to interoperability, and from ideology to efficiency. This perspective helps explain why certain blockchain networks attract institutional interest. Institutions rarely optimize for popularity. They optimize for functionality, compliance, predictability, settlement finality, scalability, cost efficiency, governance, risk management. These factors matter far more than social media narratives. As a result, purpose-built networks often receive attention regardless of market sentiment. That doesn't guarantee adoption, ladies and gentlemen, but it explains why institutional evaluation sometimes produce surprising outcomes. The criteria are different, very different. Another analogy illustrates the debate surrounding XRP and XLM. Imagine a manufacturing economy. Factories create products. Transportation networks move products. Both function are necessary. Neither replaces the other. Supporters of the XRP XLM thesis often describe the relationship similarly. One system focuses on creation and issuance. The other focuses on movement and liquidity. Whether the market ultimately adopts that exact structure remains to be seen, but the broader principle is sound. Complex financial ecosystem typically requires specialized components performing different roles. No single technology solves every problem. Now, this is what most people miss. The biggest story may not be an individual token. It may be institutional coordination. Reports surrounding industry working groups suggest that banks, asset managers, exchanges, technology providers, and infrastructure firms are increasingly collaborating on tokenization standards. That collaboration matters, because financial infrastructure only becomes valuable when multiple participants agree to use it. Technology alone isn't enough. Networks require trust, rules, standards, governance, legal frameworks, operational procedures. Building those systems takes years, sometimes decades, which is why investors should pay close attention to institutional cooperation rather than headline excitement. Regulation is another critical piece of the puzzle. Without regulatory clarity, large institutions move cautiously. With greater clarity, experimentation accelerates. Around the world, regulators continue evaluating how tokenized assets should operate. Questions surrounding custody, settlement, investor protection, market structure, and compliance remain central to the discussion. Progress is occurring, but significant work remains. This is because adoption is rarely technological change alone. It is also a legal challenge, and sometimes a political challenge. The winners of the next financial era will likely be systems capable of satisfying all three. So what happens if tokenization expands significantly over the coming years? Several possibilities emerge. First, settlement efficiency could improve. Second, collateral mobility could increase. Third, operational costs may decline. Fourth, liquidity networks could become more interconnected. Fifth, entirely new financial products could emerge. At the same time, challenges remain. Cybersecurity, governance, interoperability standards, regulatory harmonization, technological risks. No transformation occurs without obstacles. Investors should remember that adoption rarely follows a straight line. Progress often arrives in waves. But the real shift may be psychological, ladies and gentlemen. For years, blockchain was viewed by many institutions as an external innovation. Something happened outside the financial system. That perception is changing. Increasingly, blockchain is being evaluated as infrastructure, a tool, a component, a capability. And once the technology becomes infrastructure, the conversation changes entirely. The question is no longer whether it exists. The question becomes how it integrates. That is the stage where markets often experience their most meaningful transformation. As we approach the second half of this decade, ladies and gentlemen, investors are watching several key themes: tokenized securities, digital settlement networks, institutional blockchain adoption, cross-border liquidity solutions, and the growing convergence of traditional finance and decentralized technologies. Whether XRP and XLM or other networks ultimately emerge as major beneficiaries remain uncertain. What is clear is that the broader tokenization movement continues gaining attention from some of the largest financial organizations in the world. And that alone makes it worth watching, because financial revolutions rarely announce themselves with fireworks. They begin with infrastructure upgrades, quietly, gradually. Then suddenly, everyone realizes the system has changed. The takeaway is simple: short-term noise, long-term structure, as I always say. Pay attention to what's quiet. Headlines come and go. Price action fluctuates. Narratives change. But underneath it all, institutions continue exploring how digital infrastructure could reshape global finance. Whether tokenization evolves into $1 trillion market or something even larger, the direction of innovation is becoming increasingly difficult to ignore. The story is no longer just about crypto. It's about the future architecture of markets themselves, and that may prove to be the most important development of all. If you've enjoyed this breakdown, subscribe and join the Wolf Pack. Leave a comment with your thoughts. on tokenization, XRP, XLM, and institutional adoption. And let us know which financial transformation you believe will happen and be the biggest impact over the next decade. Thank you for watching. I'll see you in the next one. Well, ladies and gentlemen, hope you're having a fantastic day. I want to welcome all the new members of our Patreon, the Crypto Public Desk Monthly, all the new members of the membership channel. One good tip from the pits can easily pay for your entire year subscription. If you want the deeper macro research and learn how to take advantage of all this, come and join over 560 active traders and investors in the Patreon, the Crypto Public Desk Monthly. Ladies and gentlemen, everybody's talking about AI. Everybody's talking about data centers. Everyone's talking about energy infrastructure. Everybody's talking about defense spending, but almost nobody's talking about the one material that every single one of those trends depends upon: constant copper. And what I'm about to show you is one of the most important disconnects in the entire commodity market right now. Because while headlines keep telling people that supply is coming back, inventories are building, and everything's fine, the actual numbers tell a completely different story. And if these numbers are even remotely correct, we're looking at a market that is dramatically tighter than most investors realize. Not next decade, not 5 years from now. I'm talking right now. Ladies and gentlemen, this is the big lie that goes around in this industry. And this is not financial advice. It's just my opinion and retains myself and our organization any capacity. And this is what we see because we've been taking metals out of the ground for the last 20 years in some of the most austere regions. Here's what most people think, okay? They think copper prices are high because of speculation. Wrong. They think traders got excited about AI. Wrong. They think hedge funds piled in. Wrong. And yes, some of that is true, but that's not the main story. The main story is something much more important. The physical market's tightening. And in fact, analysts recently revised their outlook and removed approximately 350,000 tons of expected global mine supply from forecasts. That's roughly 1.5% of global mine production disappearing from expectations. Do you understand what that really means? Because that's so massive. Again, the things that are like watching paint dry on the wall are the most important things that help you get ahead in this game of finance when information is free, if you know where to look. Now, if you're not into commodities, that number may not sound impressive, but think about what just happened. The world was counting on that supply. Companies made plans around that supply. Governments made plans around that supply. Traders priced in that supply. And now it's not showing up. That's not some small forecasting error, ladies and gentlemen. That's a major structural problem. See, the mines are not recovering. And here's where it gets interesting. Two of the most important copper operations in the world, Gasberg and Kola, are recovering slower than expected. And the current expectation that neither returns to full capacity until 2028. Did you hear what I just said? Not next quarter, not next year, 2028. Markets constantly assume disruptions are temporary. Reality has a habit of extending temporary problems into multi-year shortages. And this is where most people make a mistake. They focus on demand. I'm focused on supply. Because demand can fluctuate, supply shortages are much harder to fix. They're impossible to fix. You can't wake up tomorrow and magically create a new copper mine. Woo! No, ain't going out like that. The permitting alone takes years, and it's different in each country. Construction takes years. Infrastructure takes years. And meanwhile, the world keeps demanding more copper every day. That number should terrify you, ladies and gentlemen. Let's talk about the number almost nobody's discussing. The projected ex-US copper deficit. The largest estimated deficit suggests the market outside the United States could face a deficit of approximately 640,000 tons in 2026 and 170,000 tons in 2027. That's a dramatic increase from previous expectations. Write those numbers down, add them up, drop it in a comment what it means, what you think that means. Why does that matter? Because that's where price discovery happens, ladies and gentlemen. That's where the global benchmark is set. That's where shortages become visible, and shortages create price pressure. That's why price forecasts have been revised sharply higher. Analysts now expect copper prices near 13,800 per ton in 2027, significantly above earlier estimates. Notice what's happening? The market isn't getting more comfortable. It's getting less comfortable. Every new data point seems to reinforce the same conclusion. Supply is not keeping up. The scrap problem nobody expected is what I keep telling people and clients and family offices that retain us over and over and over again. So usually when mined copper gets tight, scrap helps fill the gap. That's the safety valve in the industry. Except this time the safety valve isn't working properly. Chinese domestic scrap output is reportedly down 12% year over year because of tighter compliance and documentation requirements. That means recycled material isn't offsetting shortages the way many expected. Think about what that means. You have mine supply under pressure. You have scrap supply under pressure. And at the same time, the world wants more electrification, more transmission lines, more grid investment, more data centers, more industrial capacity. That's not the setup for abundance. That's the setup for scarcity. See, there's an AI connection everyone misses, ladies and gentlemen. This is the part that really caught my attention and what I have been saying to clients and family offices and sovereigns and funds all day. Most people hear AI and think semiconductors. Wrong. AI is becoming a copper story. Why? Because AI requires power. Power requires infrastructure. Infrastructure requires copper. The analysis suggests more than 60% of copper demand growth through 2030 could come from grid and power infrastructure. Do you realize I can't believe I'm giving this away for free. Write this down. If you're writing this down yourself far ahead of the game, think about the scale of that. That's not taking consider houses. Every new data center needs electricity. Every electricity upgrade needs transformers. Every transformer needs copper. Every transmission line needs copper. Every grid expansion needs copper. Everybody wants to own the glamorous AI stocks. Very few people are studying the industrial inputs that make AI possible. That's often where the real story is hiding. The market loves software. The physical world still runs on materials. See, the demand story is stronger than most people think. And this is the big thing to be paying attention to. See, it's these weird facts that we pay attention to, and why being a financial mercenary and understanding this is what leads to success. See, being the remora, we don't get cut up like sushi. We don't. Because when you follow things that most people don't want to follow, you get ahead where most people can only dream of getting ahead. And that's the truth of the matter. See, what's even more interesting is that what happened despite record prices, you would expect demand destruction. You're not getting that. You'd expect buyers to pull back. You're not getting that. Instead, Chinese apparent copper demand remained positive, up approximately 1% year over year in the first quarter, while grid and power infrastructure demand reportedly grew around 10% year over year. That's important because it suggests some of the fastest growing demand categories are becoming less price sensitive. So what this means in English, as I take the PhD out of PhD, these aren't discretionary purchases. They are strategic investments. Countries need energy security. Countries need power infrastructure. Countries need digital infrastructure. And those projects don't suddenly disappear because copper got expensive, ladies and gentlemen. That's what makes this market so fascinating. The traditional playbook may not work the way people expect anymore. So the real question, and this is the most important thing that I've spent hours today on the phone going over, and this is a question nobody can answer, ladies and gentlemen. What happens if demand stays resilient and supply remains constrained at the same time? Because the long-term projections show that copper market eventually moving into a global deficit by the end of the decade. Not because of speculative mania, not because of a social media trend, but because the physical world needs more copper than the system is comfortably producing. And that changes everything. Because when a market moves from abundance to scarcity, pricing power changes, investor behavior changes, government behavior changes, corporate strategy changes, entire industry changes. Ladies and gentlemen, so when someone tells you, right, copper is just another commodity, it's not. Ask them a simple question. Can you build the energy transition without it? Can you build AI infrastructure without it? Can you modernize electrical grids without it? Can you expand defense manufacturing without it? If the answer is no, and I believe it is, then maybe copper isn't just another commodity. Maybe it's one of the most strategically important assets on the planet. And maybe the market is only beginning to understand what that means. If you want to understand how to take advantage of everything I just said in the copper plays, do come and join the Crypto Public Desk monthly inside of our Patreon. One tip from the pig can pay for your entire year subscription. Come and join over 560 active traders investors who have learning the arts of the floor trader. Ladies and gentlemen, these are the biggest takeaways that I am looking at. Global copper supply expectations were reduced by roughly 350,000 tons. It's tightening the market. Major mines are recovering slower than expected, with full recovery potentially delayed until 2028. The ex-US copper market is projected to remain deficit through 2027. Copper scrap supply is not offsetting shortages as expected. AI, power grids, defense, and electrification are becoming major structural demand drivers. Analysts raise long-term copper price forecasts significantly. What I'm watching, not financial advice, just my own opinion, and it retains myself and our organization in capacity. Recovery timelines at major copper mines. U.S. copper import activity inventory accumulation. China's copper demand and infrastructure spending. AI-driven data center expansion and grid investment. Copper tariff developments in the United States. Global inventory levels and deficit trends. Why I feel that this is important, because copper sits at the center of several multi-trillion-dollar trends simultaneously. AI infrastructure, electrical grids, energy security, electrification, renewable energy, and defense manufacturing. When a material becomes essentially into multiple strategic industries at the same time, supply disruption can have outside effects on content, price, margins, investment flows, and geopolitical decisions. Understanding these trends early provides insights into where capital policy and industrial development may be heading over the coming decade. Ladies and gentlemen, trying not to get cut up like sushi here is very important, because the whole rally that we're seeing right now, like I told you, you got to go back to the early 2000s, is being pulled by commodity inputs. See, we talk to other mine and concession owners in Indonesia all day, in Chile. Most people could care less about these metals. We've been taking them down to the earth for the last 20 years. So to us, these numbers that I rattle off is no different than someone rattling off stats from your favorite baseball player, basketball player. I don't even know. But to us, this is the recipe for winning in the financial war going on right now. See, being a financial mercenary, we have to go into battle every day. But when there are multiple markets all keying off of each other, feeding off of each other, we can see where it's going. I used to trade constant copper, ranges. I remember leaving the floor of the New York Mercantile Exchange and going into physical concessions, expanding into our business with our partners. I'll never forget the first concession that we developed in Papua New Guinea. I'll never forget the first tin concession we developed. The things that you learn actually developing concessions are so valuable. But again, I don't expect most people to even quite understand it. That's why people retain myself and our organization to take the PhD out of PhD. Generational wealth is going to be created in these moves. The crypto market, the metals market, food. Food is going to become more expensive right now. At the time of this recording, stock up on motor oil if you can. That's going to be the first to be really scarce. But at the end of the day, we were talking about the scarcity in sulfuric acid with nickel and copper processing in certain countries in Northern Africa many videos ago. Had you been taking the free things that I've been saying here and writing it down, you know how far ahead you are? I love you all, ladies and gentlemen. We are the Remora because we feast on the sushi. Don't get caught up like sushi right here. Keep your Gucci conviction, your Gucci clarity. Keep walking up this frosty mountain with this frosty beverage because it's cold right now. Everybody's hurting. Yeah, the markets are down. Red days are my favorite days. DCA for whatever makes sense to you. Ladies and gentlemen, I give you the plays that we're following right here, right now for free. If you want to see how we take advantage of them and with your hand being held, you come and join the Crypto Public Desk Monthly and the Patreon. One tip in the pits can pay for your entire year subscription. I love you all. I'll see you in the front lines. This content is for informational and educational purposes only. This is not financial advice, ladies and gentlemen. Always do your own due diligence and never invest capital based on a YouTube video. Ladies and gentlemen, the ones who position early, not randomly, but intentionally, because some moments in history are loud, but the ones that change everything are quiet, right up until the moment they're not. And this is one of those moments. Do not blink because the world is distracting you with noise while XRP continues developing behind the scenes and building momentum in the broad digital asset landscape. Stay sharp, stay informed, accumulate knowledge. Your move now will be remembered. This is not the end of the story. This is just the beginning. This has opened your eyes. Smash that like button, ring the bell, and leave a comment with your thoughts. Turn on notifications, and most importantly, subscribe to Crypto Public. We break down the major global banking trends shaping digital assets today, giving you content, clarity, and research you can use. Don't just watch history happen. Stay informed, stay ahead, stay in the Republic. I love you all. I'll see you tomorrow.